Remember I told you the ultra wealthy aren't just making more money. They're using advanced tax strategies that let them pay almost nothing in taxes while building even more wealth. These aren't your typical tax tips. These are the techniques private wealth managers charge tens of thousands to implement. And today, I'm breaking them down for you. I'm Tiffany Phillips, CPA and tax strategist. Today, I'm revealing 3 advanced strategies that can create massive tax deductions and build long-term wealth. Strategies that are completely legal and available to anyone who knows how to use them. By the end of this video, you'll have access to the same techniques that separate the millionaires from the billionaires. Let's start with one of the most misunderstood but powerful tax strategies, oil and gas investment. Before you tune out thinking this is too risky or complicated, let me explain why this is so valuable for high-income earners. Oil and gas investments are one of the few remaining ways to create active losses that can offset your W-2 or business income. Most investments create passive losses that can only offset passive income, but oil and gas is different. The IRS specifically categorizes oil and gas investments as active businesses, not passive investments. This means the losses from oil and gas can offset your salary, business income, consulting fees, and any other type of active income. Here's why this is so powerful. Let's say you're making $500,000 a year and paying $150,000 in taxes. If you invest in an oil and gas project that creates a $100,000 loss in the first year, you can use that loss to offset your salary, potentially saving $30,000 to $40,000 in taxes. But it gets even better. The depletion allowance. This special tax benefit lets oil and gas investors deduct up to 27.5% of their gross income from the investment every single year, regardless of how much they invested. For example, I had a client invest $50,000 in an oil and gas project. In the first year, the project generated $38,000 in gross income. Under the depletion allowance, he could deduct $8,250 every year for as long as the well produces. Plus, through intangible drilling costs, he was able to deduct about $40,000 of his $50,000 investment in year 1, saving him $15,000 in tax right away. Yes, oil and gas investments carry risk, but the tax benefits often make these investments profitable even if the wells underperform. The key is to work with reputable operators and treat oil and gas as a small, targeted part of your portfolio. Now let's talk about one of the most powerful wealth building and tax savings strategies, private family foundations. Most people think of charitable giving as writing a check to a charity and getting a deduction. The wealthy do it differently. They use private foundations to control their charitable dollars, create massive deductions, and build family legacy. Here's how it works. You set up a private family foundation, make a contribution, and get an immediate tax deduction, up to 30% of your adjusted gross income. But you don't have to give all that money away right away. Foundations are only required to distribute 5% of their assets to qualified charities each year. The rest stays in the foundation where it can be invested and grow tax-free. You control the investments and the timing of your giving. For example, I had a client who was going to owe $200,000 in taxes. Instead, he contributed $600,000 to his foundation, got a $600,000 deduction, and eliminated his tax bill. The foundation invested the money, grew to $900,000 in 5 years, and distributed about $45,000 per year to causes he cared about. You can involve your family, pay reasonable salaries for legitimate work, and create a legacy of philanthropy. You control your giving, fund specific projects, and even start your own charitable initiatives. Now let's talk about one of my favorite tax strategies, the Augusta Rule. This rule came about because of the Masters golf tournament in Augusta, Georgia. Local homeowners rented out their homes for the tournament, and Congress created a special rule. If you rent your primary residence for 14 days or less per year, you don't pay taxes on the rental income. Here's the key. If you own a business, your business is a separate entity. You can rent your home to your business for legitimate business purposes, board meetings, planning sessions, client events, and the rental income is tax-free to you while your business gets a deduction. For example, if you charge $500 per day for 10 days, that's $5,000 in tax-free income. Your business deducts the expenses, you get the money tax-free. I had a client who held monthly board meetings at home, charging $800 per meeting. That's $9,600 in tax-free income per year, fully deductible to the business. The key is to document everything. Charge market rates, keep records of events, attendees, and business purposes, and don't exceed 14 days. The ultra wealthy don't just use one strategy, they combine them for maximum effect. Let me share a case study. A client making $2 million a year, paying $600,000 in taxes. We set up a private foundation, contributed $400,000 for deduction, invested $200,000 in oil and gas, paid $160,000 in the first year deduction. Use the Augusta Rule for $14,400 in tax-free income. Plus, we layered in real estate strategies for even more deductions. His taxable income dropped from $2 million to $800,000. His tax bill dropped from $600,000 to $240,000, a $360,000 savings in 1 year. And these weren't just one-time benefits. The investment produced income, the foundation grew, and the Augusta Rule provided ongoing tax-free income. Now, before you get too excited, let's talk about implementation and pitfalls. These strategies require significant capital and income to be worthwhile. If you're making less than $200,000 a year, some may not even be worth the complexity. Private foundations have annual filing requirements and costs. Oil and gas investments require due diligence and carry risk. The Augusta Rule requires legitimate business purposes and careful documentation. All of these require proper records and compliance. The IRS pays attention to advanced strategies, so do it right from the start. And remember, these work best as part of a comprehensive tax plan, not as isolated tactics. Work with professionals who understand how these strategies interact and fit your overall goals. These advanced strategies, oil and gas investments, private family foundations, and the Augusta Rule are the next level of tax planning. They're the reason the ultra wealthy can pay effective tax rates in the single digits, but they're not magic bullets. They require planning, documentation, and the right team. When used together, they can transform your financial future. If you want to dive deeper into these and other powerful tax strategies, grab your copy of my book, Your Biggest Expense, at yourbiggestexpense.com. The link is in the description below. And if you found this video valuable, hit that like button, subscribe for more advanced tax strategies, and drop a comment if you have questions or want to share your experience. I read every comment and often turn them into future videos. Don't wait. Start building your advanced tax plan now. The ultra wealthy aren't smarter than you. They just use better strategies. Now you know their secrets too. Thanks for watching, and remember, keep more of what you earn.